समझ रहे हैं ना आप?
लेकिन सुन के अच्छा लगा।
तो चलिए शुरू करते हैं।
Hello friends, welcome to Screen Guru. This is a faculty for General Studies. In today's lecture, we'll be seeing the first chapter of economics, that is National Income Accounting. Before moving any further ahead, let me tell you that the reference material we'll be using is class 11th NCERT on macroeconomics. So now, let us understand the history of national income accounting in the country. It was in the year 1867 when Dadabhai Naoroji first attempted to publish the national income of the country, and that is when he subsequently came up with the train of wealth theory and so on, and we got independence. Between that time, no much effort was taken by the government to come up with a national income accounting. So post independence, the first national income data was submitted in the year 1954 by Professor Mahalanobis committee, which was formed by the central government. So later on, from the year 1955, Central Statistical Organization was responsible for national income accounting or national income calculation. So CSO, or the Central Statistical Organization or office, is also responsible for publishing of some other surveys or data also, which is the economic census, the annual survey of industries, statistical yearbook, index of industrial production, the 5-year plan, and many other data also. So at present in the country, the National Statistical Office that was formed in the year 2019 after the merger of Central Statistical Office and National Sample Survey Organization, and which comes under the Ministry of Statistics and Program Implementation, is responsible for publishing of the national income data or the GDP data. Okay, let us understand why GDP calculation or national income accounting is very important. So before that, I want you to answer one question, like, when can you call a country to be progressive? Can we call a country to be progressive if it has a lot of resources alone? If that is the case, then African nations should be the most progressive countries. They have abundant resources, but still they are not progressive. So a country can be progressive only when it is capable of utilizing the resources and making production out of the resources and then selling it and making a revenue. That makes a country progressive. So national income accounting measures the progress of a country, how much the country has fared compared to the last year. So that is what national income accounting does. It gives us an idea of the development in the country. So to compare growth with other nations, also national income accounting is used. So the per capita national income accounting is used to compare how much India is doing compared to US or China likewise. And how do we calculate the national income accounting? We measure the national income accounting by following the flow of production and other related activities. So what is it, the flow of production? Flow of production, we can say, is like the sum total or the aggregate of all the goods and services produced in the country. I'll explain everything in detail. So let us just know, like, flow of production means the sum total of all the goods and services that are produced in the country in the monetary terms, in terms of money. So before going into the circular flow of economy or the circular flow of income, let us discuss some terminologies that are necessary for understanding the circular flow.
It's a concept of flow and stock. So what exactly is flow and what is stock? So you can define flow as the goods and services that are produced over a time period and stock as the goods and services that are produced at a point of time. So what does it mean? Say for example, you are saying like the country made 1 ton of steel or the country made 2 tons of rice. What does it imply? Does it imply anything when you're not specifying the time? Actually, it doesn't. So you have to specify the time and saying like the country made 1 ton of steel this year. So over a period of time, the production that happens in the country is called the flow. And stock, on the other hand, is like, take an example of a capital good. So this year 10 machines were made. The next year similarly 10 more machines will be made. So at the end of the second year, the total stock will be 20 machines. But when you're taking the consumption goods into example, like how I said, 1 ton of rice, that 1 ton of rice will last for only 1 year. But stock on the other hand will be the aggregate at a point of time. So if you're clear with that thing, let us move ahead and go continue with our circular flow of income. Before that thing, we'll discuss some more terminologies. So when I mentioned national income accounting or GDP calculation, I said the final goods. I said GDP is the sum total of all the final goods and services produced in the country. What exactly is a final good? Final good is that particular good where you cannot do any further value addition. Say for example, you are a cotton farmer and you have produced some raw cotton, which you will sell to a textile mill owner. He'll convert that raw cotton into a dress, which will be finally bought by a customer. So that shirt is the end product or the final good, because that shirt cannot be improved any further. So you cannot do value addition to that shirt. While all the other materials, the raw materials that went into making the shirt, is called the intermediate good. So final good can be of two types, that is capital good and the consumer good. So what is a consumer good? So for example, the goods that or the goods and services that we consume, like fooding, clothing, and like recreational activities, recreational services, which are consumed by us, are called consumer goods or consumption goods. And what is capital good? Say for example that you need an industry. So what are the requirements of the industry? Industry needs an infrastructure, they need tools, they need machinery. So those things are called capital goods. So capital goods are also, like when I said before, investments which can be used for creating further goods, which can be capital or consumption goods in nature. Okay. So friends, what are the peculiar features of a capital good? So capital good, it forms a part of the flow only on the year it was made. From the next year onwards, it will form the part of the stock. What does it mean? It means that capital good would last for some number of years compared to consumer good. That time you will have a doubt, like the TV that we have at home, the washing machine, the car that we use at home are also consumer goods, but they also have a long period. Then why is it so? So those consumer goods which are similar in property to the capital goods that have a longevity that can be used for more than a year are called consumer durables. Okay, like the TV, the washing machine, the pressure cooker that you use at home, these are all consumer durables. So coming back to capital good is also called gross investment. How can we call something an investment? So in economics, investment doesn't mean investment in stock market or financial investment. It means investing or capital creation. So that is what you call as gross investment. So why do you need this term gross? We'll learn it through an example. Say for example, this year 10 machines were made. Next year another 10 machines will be made. So at the end of the second year, totally we are making 20 machines. That is your gross investment in the country. And what is net investment? Say for example, a machine will undergo wear and tear for sure every year. And in order to compensate for that wear and tear, like 5 machines have stopped working. And then we need to replace that 5 machines with the 5 machines which was made in the second year. So in total, we will only have 15 working machines at hand. And the deletion or the 5 machines that were taken up from the second year's production into the total investment, it is called depreciation. So what is depreciation? The deletion which is made from the value of the gross investment in order to accommodate regular wear and tear of capital is called depreciation. So let us examine this concept in detail. Okay, now let us consider a new machine that a firm invests in. This machine may be in service for the next 20 years, after which it falls into despair and needs to be replaced in the next 20 years. Okay, we can now imagine as if the machine is being gradually used up in each year's production process, and each year 1/20th of its original value is getting depreciated. So instead of considering a bulk investment for replacement after 20 years, we consider an annual depreciation cost every year. This is the usual sense in which the term depreciation is used, and inherent in its conception. So depreciation is thus the annual allowance for wear and tear of a capital good. Okay, so if you have understood depreciation, let us move into the circular flow of income. So in circular flow of income, what happens is like we imagine an imaginary economy where we have only two entities. Okay, this is the simplest form of circular flow income. This is for the understanding of everyone. So here we have two entities, that is household and firms. So what exactly do they do? So firms are the ones who produces the goods and services that we require, and households are the one who buys the services and goods that they produce. So if you look at the dotted line A, you can see that the household will spend money for the goods and services that the firm makes, that is represented by the dotted line B. So what is this factor payment and factor service? Say for example, the firm needs capitals like land, machinery, then human capital, then resources, raw materials for making the final goods and service. So where do they get these factor services from? They get the factor services from the household. Say from our house, we'll be sending people to the factory to work, and what they will get in return? They will get in return the factor payment called wages. And now imagine that we are landowners and we are renting our land to the factory or the firm. So what we'll get in return as factor payment is rent. And say for example, you are giving some machinery or some capital, you will get rent. Okay. And if you are investing something in the firm, what you will get in return? We will get in return the interest. So factor services are the things that are required by the firm to make the final goods and service. And the firm in turn would repay the household in the form of factor payments for the services or for the resources that the household is providing to the firm. Say for example, the A and B dotted line are called goods and services market, because as the name suggests, we can see that goods and services will be provided by the firm to the household, and household in turn will be spending the money A to the firms. Okay, and C and D are called the factors of production market, wherein households will be supplying the factor services and firms will be paying the factor payment to the households. So now you must be wondering, what is the relevance of this thing? So this circular flow of income can be used to calculate the national income of the country. How is that so? Because all the lines means only one thing. You doesn't matter which dotted line you are taking for calculating the national income. Ultimately, if you sum up the cost or the value of all the things happening in a single dotted line, you can find the national income of the country. Say, take the example of dotted line A, which is the aggregate spending. So aggregate spending of the household means it is the cost that the household is paying for all the goods and services produced by the firm in the country. See, this is a hypothetical situation where you have to imagine two things. That whatever goods that the firms are making are being bought by the households. So nothing is being wasted, there is no leakage of money. So goods and services, the value of goods and services in terms of money is being paid by the household. So if you are calculating national income account using the line A or spending, that method of calculating national income is called expenditure method. And if you are calculating national income accounting by using the product method or by tracing the path B, it says only one thing. It means that you are using the product method. What is product method? Product method will be sum total of all the goods and services produced into the cost of the goods and service. Okay. And if you follow the income method, which is line C, it means the firms will be giving the money or the factor payment to the household, which they in turn can spend on the firms to buy goods and service. So that factor payment is the income to the household, which also will be equal to A or B. So that way we can calculate the national income using income method. So let us move into a little bit complex circular flow of income, wherein government and banking and even the external market is involved. See this example. So it has all the other things which were mentioned earlier. Along with that, we are including government and bank. So how does the government or bank plays here? So what the household does is like household will make savings in the banks. Okay. And banks would in turn give that money to business to invest. Okay. Now say example, what is the role of the government? Government will be collecting the tax from both houses and business, and then they in turn will be doing government expenditure denoted by the letter G. Okay. Let us now learn how we can calculate the national income through expenditure method by using the circular flow of income diagram. Okay. Look at the circular flow of income diagram. We are calculating using expenditure method. So like I said, for the goods and services that the business provide to the household, consumer will be paying the money. That is called the consumption expenditure, remarked by the number letter C. Okay. So national income is not just C in an open economy. In a complex economy, it is the sum total of the consumption expenditure plus the savings that the household does in banks plus the tax that the household pays to the government plus X minus M means export minus import. So the value of the goods exported minus the value of goods imported plus R minus P is the net factor income from abroad, where R is the remittance, which means the money that we get from outside countries, and P is the payment that we do to foreign countries. Okay, which can be in the form of like you're going to a foreign country, visiting there and spending money there, or it can also be like a foreigner is working for your country here, but he'll be taking the payment there, or a foreign corporate is working here, they'll be taking their payment to their country. So that is what is R minus P. So that can also be said like Y is equal to C plus I, where I is the investment done by the businesses, plus G, that is the government expenditure, plus X minus M plus R minus P. So one thing we have to note here is like S is equal to I. How is that so? Because whatever investment savings that you are doing at the banks will in turn go to the business as in the form of investment. So banks will be providing the business money to invest. So S will be equal to I and T will be equal to G, because the tax amount that both households and businesses pay to the government will be using that tax amount for government expenditure or government capital formation. Okay, so these two equations notes the national income accounting, or how national income is calculated using the expenditure method. So friends, that winds up today's lecture, and in the subsequent classes we will be discussing how national income is calculated using product method and income method, and we will discuss the different forms of GDP and the different terminologies related to GDP which will be necessary for your examination. So hoping that you all have enjoyed the session. So thank you and have a nice day.
Just then.
So please subscribe, whatever. Please I want to reach 1 million.